Hello friends, I am CA Abhishek Zavre here. I welcome you all to the lecture series on financial management. Before we begin, there are some basic points. Number one, these audio lectures I am recording while traveling, so there could be an issue on audio, as well as my throat condition is not up to the mark, so there could be an issue. But let me assure you that quality of the content, academic content, will be the top-notch one. Number two, if possible, please keep Nano book along with you while listening to these audio lectures. I made a Nano book on financial management, which is basically covering chapter summary and formulas on financial management. If possible, you keep it. Even if it is not available, it is okay. Number three, I'm going to keep the discussion short and crisp. This is obviously not a substitute for the entire lecture that you have done for a financial management. This is as a supplement to what you have already studied. Number four, medium of instruction is primarily going to be English. Occasionally, I may use Hindi words if I get across with the Hindi at all. Thank you. Let's start with the first chapter in this series. We begin with capital structure. A finance manager is concerned with three types of decisions. Number one, procurement of funds, also known as financing decision, where he is concerned with raising of funds. Number two, utilization of funds, also known as investment decisions, where finance manager is concerned with making investment of funds raised into the business and ensuring that return on capital employed or return on investment is higher than cost of the funds raised. Whatever funds you raise carry a certain cost, also known as a cost of capital or expectations of investors. So you will make a utilization of funds by making investment with the objective of earning higher return on investment than cost of capital. And the third decision with which a finance manager is concerned with, you must not forget third. Many people do forget the third decision. It's a dividend decision, also known as a distribution of profit. A business enterprise will carry or earn certain amount of profit. Those profits must be either plowed back into the business or distributed among owners of the business. So how much profit should I invest back in the business? How much profit should I distribute by way of a dividend? It is known as dividend decision. The chapter that we have taken up for discussion is a capital structure. It is primarily concerned with procurement of funds. So what is capital structure? Let me explain. Capital structure is proportion in which funds required for the business are raised. A business enterprise will require funds for long term as well as short term. Generally speaking, capital structure is calculated for long term funds, not for short term funds. Generally, somebody can include short term funds also, but generally capital structure is for long term funds. I hope you make a note of it. So, whatever long term funds I require for a business enterprise, I'm going to raise it from equity, from debt, and from preference share capital. The proportion in which I raise these funds is known as a capital structure. Now, before I begin with subsequent technical discussion, I want to make few points clear on capital structure. Number one, capital structure can be expressed either with reference to book values as per balance sheet or books of accounts, or capital structure can be with reference to market value of your equity, debt, and preference shares. Whenever capital structure is expressed with reference to market value, it is known as enterprise value. I use the word enterprise value. Second point, capital structure does not remain constant. Proportion is going to change over a period of time As company earns a profit, your equity component will increase. As you repay debt, debt will come down. As you redeem preference shares will come down. So the changes in capital structure are inevitable. Change hote hi rahega. So it's not that you're going to have a constant capital structure. Number 4, equity, which I referred in the capital structure, does not mean only equity share capital at its face value. Equity also includes reserves and surplus, which is profits plowed back. So to sum up, capital structure is a proportion in which funds are raised by a business enterprise through mix of debt, equity, and preference shares. Certain companies do use a debt. Certain companies do not use a debt. Those companies which use debt in their capital structure are known as levered companies or geared company. I repeat, levered/geared company. Whereas those companies which do not use a debt in their capital structure are known as unlevered company or ungeared companies. Generally speaking, companies with high amount of debt carry higher financial risk, and hence the market value of these companies may be affected due to the higher levels of debt. So when you take a capital structure decision, you have to keep in mind various factors. I'll come down to those factors now. We understood the basic meaning of capital structure. One single word, capital structure is equal to proportion. One more point I would like to highlight before I turn on to factors. Some great characters in our country refer authorized capital, paid-up capital, or issued capital as a capital structure. There is one website called the Money Control. On Money Control, let's say various companies show capital, various companies' capital structure is shown. It is basically authorized capital, issued capital, and paid-up capital. Please remember, that is really not the capital structure. That is a breakup of share capital shown in the balance sheet. What we are discussing here in a finance or in the subject of financial management is a breakup of debt, equity, and preference shares. Within equity, you can raise equity from private placement by way of a public offer or by way of a issue outside India in the form of global depository receipts, or you can make a raising of funds within a country. So there are various methods of raising funds. Those are discussed in great detail in a chapter called as Sources of Finance. In this chapter, we are concerned only with capital structure. So capital structure is equal to proportion in which funds are raised. Second point, factors affecting capital structure decision. What are the factors on which you will take a decision? Imagine you are getting married, or you will get married at some point of time. There will be certain factors that you will keep in your mind while deciding the bride. While deciding the bride. So, what factors do you keep in mind? Certain factors you will have. Exactly like that, there are certain factors which I'm going to consider while deciding capital structure. Some of these factors are capable of being expressed in number terms, so they are quantitative factors, whereas some of the factors need qualitative explanation. Both the factors I'm going to discuss together. So let's begin our journey of this capital structure. First factor is financial risk. Whenever you raise debt in your capital structure or you have preference shares, you have an obligation. Obligation is to repay amount of debt or preference shares, as well as to pay a fixed amount of interest or preference dividend. Hence, financial risk is higher in case of debt, lower in case of equity. It is also a risk that your operating profit that you generate from your business may not be enough to pay off this interest and debt capital. Hence, while raising funds, one must consider levels of debt and levels of financial risk. Word financial risk is measured by financial leverage on a primitive basis. You should take risk into consideration. Second factor, cost of capital. Cost of capital is expectations of investors. Debt has a lower cost of capital. Equity has a higher cost of capital. So you should make an appropriate mix of debt and equity to decide amount of or proportion of capital structure. Third factor that you should consider is a dilution of control. Whenever business enterprise raises additional funds by way of equity, control of existing shareholders over the company does come down. But when additional funds are raised by way of debt, control does not come down. So, if you are really concerned about the control of existing shareholders, you should be looking for debt as a source of finance. You should not be looking at equity as a source of finance. But if you are not worried about the control of existing promoters or existing management, you can look out for equity also for raising additional funds. The question of dilution of control comes only at the time of raising additional funds and not raising funds at the very beginning of formation of company. So three factors we have discussed: cost of capital, risk, and dilution of control. These are the three basic factors which make a lot of difference in a capital structure decision. Fourth factor is government regulations. In many situations, government regulations like Foreign Exchange Management Act or other laws set up by central bank do not permit higher levels of debt or have restrictions on the amount of debt. Or if you want to do the buyback of equity shares, there is a restriction on debt equity ratio. So you should keep in mind regulations prepared by government, maybe Companies Act, maybe Foreign Exchange Management Act, maybe Banking Regulation Act. And on the basis of that, you should decide capital structure. Next factor, flexibility. Whenever you raise capital, you may want to make some alterations to your capital structure at a later date. Keep in mind whether flexibility is available while raising funds or not. For example, if you raise money by way of equity, flexibility is almost not there because you cannot reduce the amount of equity or you cannot do the buyback of equity shares easily. You can do the buyback, but not easy. So flexibility is more when it comes down to debt. Flexibility is lesser when it comes down to equity. Next, coverage ratio. When you raise money by way of a debt, you need to have enough amount of profits to ensure obligation of interest as well as obligation to make a payment of principal. So you should calculate debt service coverage ratio and interest coverage ratio to check whether the coverage ratio is within comfortable limits of management or not on estimated basis or expected basis. Calculation of coverage ratio we are going to discuss in detail in a ratio analysis chapter. Similarly, calculation of the cost of capital also is going to be discussed in a cost of capital chapter. And lastly, you should consider cash flows that are expected to be generated. If there is going to be a lot of stress on cash flows, debt should be avoided. And if cash flows are expected to be more or less certain, equity can be preferred. Please remember, whatever factors I discussed are not exhaustive. There are a lot of factors in addition to this that you have to take into consideration in real life. And in spite of considering all factors, conclusion as to which proportion is the best is not easily possible in reality. Reason being, capital structure decision is not a science, is an art. One has to have a lot of experience as to the industry, as to the market in which you are operating before you finally take a decision on capital structure. So this is more of art that we are practicing. Let us proceed ahead towards number crunching, because ultimately for exam, number crunching is relevant. So we discussed two things. I will keep on giving this cumulative revision as such. Number one, we discussed meaning of capital structure. Number two, we discussed factors affecting capital structure. Next, what is optimal capital structure? Optimal capital structure means a capital structure at which wealth of shareholders is maximum, highest. Wealth of shareholders is measured by market value of equity shares or fair value of equity shares in case shares are not listed on a stock exchange. So, whatever capital structure decision we are going to take should be taken in such a way that wealth of the
Ekatvam
shareholders
Academy,
is
Pune.
maximized. However, there is no formula which will tell you that this will be your market price if you take this particular decision. The decision of capital structure should be taken by applying experience of the management, by applying variety of past data and looking into the futures, looking into the expectations of management. So what is optimal capital structure? Theoretically, I can explain optimal capital structure means a capital structure at which market value is highest. But if you ask me what is the formula for determining this optimal capital structure, let me tell you, there is no single formula. There are various theories on capital structure that are given by various academicians as well as great persons like Modigliani and Miller who won the Nobel Prize. These theories as to what is best capital structure we will be discussing once cost of capital
Ekatvam
chapter is
Academy,
discussed, not
Pune.
at the beginning. You should learn theories after cost of capital chapter. So optimum capital structure is the one at which market value of the company is highest. Now I am turning towards various numerical points in the chapter in the form of a formula. So I'll be discussing various formulas that are required for solving sums or various points that are required for solving sums. First formula that I'm taking up for discussion is price earning ratio. PE ratio as it is popularly called. Price earning ratio is equal to market price of a share divided by earnings per share. EPS. Market price divided by earnings per share. Market price you are going to take up from stock exchange in case company is listed. In case company is unlisted company, you can still calculate by calculating fair value. Valuation of shares is
Ekatvam
altogether
Academy,
separate
Pune.
area for discussion. So you calculate a fair value divided by earnings per share. Now which earning per share you should take? Whenever you are calculating P ratio, you should take earnings per share of last 12 months. Let us say I'm calculating a P ratio on 15th of June 2018. So 15th June 2018, when I'm calculating P ratio of any particular company, I will look at the previous 12 months for which the profits are available or profits are reported by company. The previous 12 months will be 1st of April 2017 to 31st of March 2018. For those 12 months, whatever profits company has earned on a per share basis, known as the earning per share, computed under accounting standard number 20, will be part of our denominator. And price on 15th of June will be numerator. So price per share divided by earnings per
Ekatvam
share
Academy,
will give
Pune.
you P ratio. Formula is very simple. Why are we discussing this formula? When you want to take a decision as to capital structure, I told you your objective should be to maximize market price of a share or wealth of the shareholders. So what we do is we make a projected profitability statement or projected income statement. And once we make a projected income statement, we arrive at earnings per share. And that earnings per share is multiplied by expected PE ratio. So you should know how PE ratio is calculated and how estimates of PE ratio are made. To make an estimate of PE ratio, you have to do analysis of risk. If it is expected that in future going forward, risk is likely to go up, you should have lower P ratio as compared to what you are having right now. If it is expected that risk is going to come down, P ratio will go up.
Ekatvam
So
Academy,
basically
Pune.
risk and a P ratio have inverse relationship. Whereas the growth of the company and the P ratio have positive relationship on ceteris paribus basis. So if company is likely to grow faster or grow at a higher speed in future, P ratio is expected to go up. So what I'm saying is you make a expected profitability statement oblique income statement and multiply that earnings per share, expected earning per share by PE ratio. Expected earning per share is also known as forward PE. Forward PE matlab, forward EPS. Forward EPS multiplied by forward PE ratio is going to give you probable market price of a share. So I will make multiple columns of capital structure as under, let us say, particulars, capital structure A, capital structure B, capital structure C. Under each of the plans, I will
अकॅडमी पुणे
estimate my earnings per share in the future, forward EPS, multiply that by forward PE ratio, expected PE ratio, you will get expected price of a share. This is our first technique to evaluate capital structure decision. Obviously, to arrive at expected EPS and expected PE ratio, you will need to know a lot of things. But from exam perspective, these things will be printed in the question, so you did not bother. But in real life, you have to understand business structure, you have to understand operating risk, you have to understand financial risk, you have to understand the sector in which you are operating, you have to understand macroeconomic environment in the country, expectations of the GDP growth rate going forward, government policies, variety of factors you have to look into before you come down to expected EPS or expected PE ratio. I hope you got a reasonable understanding of PE ratio. Few more points. PE ratio is basically price as a multiple of earning per share. So one can say that if you buy share at a current market price and if there is no growth in earning per share at all, which will not happen, but assume for the sake of it, let's say there is no growth in earnings per share, you continue to earn the same profit. P ratio basically tells you the time that you will take to recover your market price or to recover your investment, assuming all the profits are distributed by the company by way of a dividend. So market price is numerator. Let's say particular company's market price is 150 rupees per share. And let's say EPS is 25 rupees per share. So P ratio is 6 times. 6 times का मतलब क्या है? अगर मैं वो शेयर 150 रुपए को खरीदता हूं आज, तो कंपनी हर शेयर के पीछे 25 रुपया कमा रही है. अब कंपनी को 6 साल लगेंगे टू अर्न 150. तो अगर कंपनी हर साल 25 रुपया कमाती है और अगले 6 साल तक ऐसा ही कमाते रहती है और वो पूरा का पूरा कमाया हुआ पैसा कंपनी डिस्ट्रीब्यूट करती है, विच विल ऑल्सो नॉट हैपन इन रियल लाइफ, बट अज्यूम इफ दैट इज डन, यू विल टेक 6 years to get your money back. Please remember, in this calculation, I'm not considering any growth. In this calculation, I'm assuming all profits are distributed by way of a dividend. Both these assumptions do not hold true, but it gives you a rough understanding of time required to get back your money. Number one. Number two, as risk levels in market increase or in the market goes in the bearish mode, P ratio of multiple companies will come down. And as market goes into the bullish mode, P ratio does go up. So P ratio tells you a lot about the market condition, but P ratio is of generally no use in case of a company is making loss in the past. So in case of loss making companies, we really do not look at the earnings in the past. We look at the forward earnings or the futuristic earnings. Another point on the P ratio, in general, if you look at the Indian market on an overall basis, National Stock Exchange is the index number called as the Nifty. Nifty has a P ratio in the range of 18 to about 23-24. This is general range in which the P ratio of the companies that are traded on the stock exchange on overall basis, average basis is traded. One personal advice to you people, whenever P ratio in the equity market or of Nifty is at the range of 23-24, be cautious as to additional investment. That could be the indication that the further increase in the market price of share is lesser. You should invest more money at that point of time into the debt, or additional funds that you have should be shifted towards debt. And when the P ratio comes down at the bottom range of 17-18, you should increase your allocation towards equity slowly and slowly. These P ratios are easily available on the websites of various stock exchanges as well as companies to report it. I proceed ahead with the next point. Next point that I'm taking up for discussion is a debt equity ratio. Debt equity ratio in general means amount of debt divided by amount of equity. Amount of equity is equity share capital plus reserves and surplus. Numerator is a debt. Debt is short-term debt plus long-term debt, both put together. So debt equity ratio tells you debt as a proportion of equity. Debt equity ratio. Debt equity ratio basically tells a financial risk attached to a capital structure. Higher the debt equity ratio, higher the financial risk. In calculation of debt equity ratio, certain academicians say that only long-term debt should be included. There are two schools of thought: long-term debt plus short-term debt divided by equity. One school of thought says only long-term debt
Ekatvam
divided by
Academy,
equity.
Pune.
In exam, you have to make a suitable assumption and calculate the amount of debt equity ratio or debt equity ratio as such. I proceed ahead with the next point. Next point that I'm taking up for discussion is uncommitted earnings per share. UEPS. Uncommitted earnings per share. My friend, you calculate earnings per share after deducting all operating expenses, all non-operating expenses, all financial expenses, all taxes from sales. So sell minus all expenses, operating, non-operating, financial, tax, interest, preference dividend, everything. What amount remains? Residuary amount. That residuary amount goes to equity shareholders, and that residuary amount divided by number of equity shares is known as earnings per share. Earnings per share basically tells you how much company has earned
Ekatvam
during a
Academy,
particular period
Pune.
for equity shareholder. But there is one very important thing that is ignored in calculation of earnings per share. That is commitment of the company to repay its debt and preference shares. P&L is debited by amount of interest. P&L is not debited by principal amount of loan that you have taken. Whenever you take a loan or you raise money by way of debentures, you have two obligations. One is to repay principal and the other obligation is to pay interest. Interest is considered. Interest is already deducted in calculation of earnings per share. However, principal amount is not deducted. So to take into consideration principal amount, we have concept of uncommitted earnings per share. So let me first take you to the formula of EPS. EPS is equal to earnings available to equity shareholder divided by number of equity shares. But in this numerator,
Ekatvam Academy,
we are
Pune.
ignoring commitment given towards lenders that we will pay your money back. So if I consider that commitment, I get formula of uncommitted earnings per share. Uncommitted earnings मतलब earnings for which there is no commitment. टोटल अर्निंग जो होता है कंपनी का उसमें से कुछ पैसा आपको बाजू रखना होता है टू मीट ऑब्लिगेशंस ऑफ डेट टू मेक let's say capital expenditure for expansion purpose. So uncommitted earnings per share is calculated as earnings available to equity shareholder less amount of sinking fund obligation to repay debt divided by number of equity shares. That is uncommitted earnings per share. Now, why did we calculate this UEPS or uncommitted earning per share? When you want to take a decision of capital structure, you should not look at only earnings per share. You should look at UEPS
Ekatvam
also. It could
Academy,
happen
Pune.
that EPS is positive, but UEPS is turning out to be negative. Or EPS is a good number or reasonable number, but UEPS is a very small amount that you are earning on per share basis. Now, if UEPS is very small amount or UEPS is negative, that is indication that you are carrying extremely higher levels of risk. You should take into consideration impact of this risk on a market price before you take a decision of capital structure. So that was the third formula that we discussed. We discussed PE ratio. We discussed debt equity ratio. We also discussed uncommitted earnings per share. I proceed ahead with the subsequent formula or subsequent concept, indifference point. Indifference point basically means, in general, not in FM, indifference point means a decision which, if taken, you will be indifferent between two alternatives. It will not
Ekatvam
make a difference
Academy,
to you
Pune.
whether you choose alternative A or alternative B. You are indifferent between the two alternatives. Now here in a financial management, especially with reference to capital structure, indifference point means amount of EBIT, earning before interest and tax, or amount of operating profit at which your earnings per share is same between two capital structures. Let us say I have capital structure A and a capital structure B. A is with equity only, B is a mix of equity and debt. I want to know what should be my operating profit so that earnings per share remains same under both equity plan and debt plan. To calculate that amount of operating profit, we have a formula of indifference point. So Indifference point in a concept terms means amount of operating profit at which earnings per share is same for two financial plans. Indifference point is calculated at for two financial plans or two capital structures only. अगर आपके पास तीन या तीन से ज्यादा कैपिटल स्ट्रक्चर के ऑप्शंस आपके सामने अवेलेबल है तो यू हैव टू मेक अ कॉम्बिनेशन. फॉर एग्जांपल आई हैव कैपिटल स्ट्रक्चर ए, बी एंड सी. तीन ऑप्शंस मेरे पास है तो मुझे तीन अलग अलग इंडिफरेंस पॉइंट निकालने पड़ेंगे. इंडिफरेंस पॉइंट फॉर प्लान ए एंड बी, प्लान ए एंड सी एंड बी एंड सी. So let me come down to the formula of indifference point. Let us have two plans, plan A and plan B. So I will say EPS of plan A should be equal to EPS of plan B. EPS of plan A is equal to EPS of plan B. This is a basic line from where the formula is going to start. But how do I get the EPS of plan A? EPS of plan A will be EBIT minus interest under plan A, bracket complete, into another bracket 1 minus T, minus preference dividend under plan A, minus dividend distribution tax under plan A, divided by number of equity shares of plan A. So basically what I'm doing is, I'm calculating earning available to equity shareholder in plan A and dividing by number of equity shares so as to get EPS under plan A. Just like I calculated EPS under plan A, I will also calculate EPS under plan B on right hand side. And EBIT will remain same in both the plans. So we will create an equation of left hand side is equal to right hand side. EBIT is minus interest into 1 minus T minus PD minus dividend distribution tax divided by number of equity shares. I keep this equation on the left hand side and right hand side and I solve this. The amount of EBIT which I will get by solving this is nothing but indifference point. Okay, what is the use of this indifference point for deciding capital structure? Let me tell you the use. If you want, once you find indifference point, remember up to indifference point is the EBIT. So up to indifference point, one financial plan will be dominating another financial plan. One financial plan will be dominating another financial plan. Generally, up to indifference point, equity plan or a plan which has a more equity dominates plan which has a more debt. So what you should do is, once you calculate indifference point, you should draw a graph by taking EBIT on x-axis and earning per share on y-axis and draw a line of EBIT EPS under both the plans, plan A, plan B, or whatever the plans you have in front of you. So once you draw a graph, the point at which they intersect is the indifference point. But you will come to know that up to indifference point, one plan has a higher earning per share, and after indifference point, another plan has a higher earning per share. Generally speaking, up to indifference point, equity plan dominates, and beyond indifference point, debt plan dominates. Debt plan matlab plan having more debt. It is not possible to have a plan with only debt. So that was the indifference point analysis, which helps you for calculation of capital structure or taking decision as to capital structure. So we discussed four formulas. Number one, we discussed price earning ratio. Number two, we discussed debt equity ratio. Number three, we discussed uncommitted earnings per share. And now we discuss indifference point. Remember, indifference point can also be calculated for same uncommitted earning per share. That is same UEPS. You can calculate indifference point for same EPS, or you can calculate indifference point for same UEPS. Choice is up to you. One more point. If number of equity shares in both the plans is same, that is denominator is same in calculation of EPS in plan A as well as plan B, then indifference point cannot be calculated. What do I mean by indifference point cannot be calculated? These two plans will never intersect with each other in a graph. One plan will always dominate over the other plan. That is the meaning of indifference point cannot be calculated. So that was indifference point for you. Let me proceed ahead with the last formula of this particular chapter. I'm not discussing capital structure theories in this chapter. I'll be discussing after cost of capital. So last point in this chapter which helps in formula is a financial break-even point. Financial break-even point is the amount of operating profit at which earnings per share is zero. I repeat, this amount of operating profit at
Ekatvam
which
Academy,
earnings per
Pune.
share is zero. Remember, in indifference point, it was for two plans. FBP, financial break-even point, is not for two plans. Financial break-even point is for one plan. It is not for two plans. So financial break-even point is EBIT at which earnings per share will be zero. Indifference point was EBIT at which EPS will be same, but between two plans. Now I'm not talking about two plans. Remember that. Okay. So how do I calculate financial break-even point? There is a formula. There is a logic. Logic says prepare a profitability statement starting from EBIT to earning per share. Keep earnings per share equal to zero. What did I say? Keep earnings per share equal to zero. And go in a reverse direction from bottom to top. So what is your profitability statement? Profitability statement will be sales less variable cost, therefore
Ekatvam
contribution.
Academy,
Contribution
Pune.
less fixed cost, therefore EBIT. This part is really not required for capital structure chapter, but I explain. So EBIT minus interest, earning before tax. Earning before tax minus tax is earning after tax. Earning after tax minus preference dividend minus dividend distribution tax on preference dividend is earning available to equity shareholder. Please remember, you are supposed to take DDT only on preference shares. Is earnings available to equity shareholder. Earnings available to equity shareholder divided by number of equity shares is earnings per share. Keep this earning per share equal to zero, and by keeping earning per share equal to zero, you do a reverse working from bottom to top. You will get EBIT. That EBIT is nothing but financial break-even point. This was logic. But let us say that you want to use a formula. Can you get the answer by way of a formula? Yes,
Ekatvam
you can get the
Academy,
answer by way
Pune.
of a formula also. What's the formula? Financial break-even point is equal to interest plus is separate point plus preference dividend plus dividend distribution tax divided by 1 minus t. Please remember, you are not supposed to do divided by 1 minus t to the interest part. Interest plus PD plus DDT upon 1 minus t. I hope you got it. Interest plus PD plus DDT upon 1 minus t. Got it? This is financial break-even point. We have already worked out one break-even point in the leverage chapter called as operational break-even point. Operational break-even point was sales at which EBIT is zero. Now we are saying EBIT at which earning per share is zero. Remember the words carefully. OBEP was sales. It was expressed in terms of sales. ऐसा सेल्स जहां पर EBIT जीरो है.
Ekatvam Academy,
अब हम बात
Pune.
कर रहे हैं ऐसा EBIT जहां पर EPS जीरो है. और indifference point was ऐसा EBIT जहां पर EPS same है between two financial plans. So these were the formulas which will be helpful for you in solving sums. In addition to this, there could be some sundry formulas like dividend payout ratio, which is basically dividend as a percentage of profit. There could be a sundry formula for calculation of amount of debentures, which is basically amount of interest divided by rate of interest, and so on. So I discussed all the formulas. I not discussed capital structure theories. I hope I have discussed the entire chapter in a short and crisp manner, and I hope you will find utmost benefit out of this. Please do give your feedback by way of SMS or WhatsApp on my mobile number, which is 98508. I repeat, 98508 34971. 98508
Ekatvam Academy,
34971.
Pune.
Or you can write an email to me, Abhishek Zavre, ABHISHEK, ZAWARE, @gmail.com. Preferably WhatsApp would be better. Thank you for patient listening. Thank you.
Ekatvam Academy, Pune.